Hi everyone, welcome back to the channel. Today we are going to start with merger and acquisitions, questions related to merger and acquisitions. Previously we have discussed about valuation questions, DCF questions, discounted cash flow questions. We have discussed about enterprise value and equity value questions, and also about accounting, basic and advanced questions. Now we are going to start with merger and acquisition. Before we start with merger and acquisition, I would like to give you a brief about what merger and acquisition is and how does it looks like, a step-by-step professional workflow. So merger and acquisitions refer to the strategic process of combining two or more companies into one entity. A merger is when two companies of similar size agree to combine and form a new entity. Previously, there was a merger of Exxon and Mobil, which came out to be ExxonMobil. So an acquisition is when one company purchases another, gaining control over its operations, assets, and management. If, example for that is Facebook acquiring Instagram. So there is a difference between merger. So two companies are getting merged, and for acquisition, acquisition is a different process. Merger is a different process. Acquisition, if we talk about acquisition, so Facebook acquired Instagram, and Facebook also acquired WhatsApp. And if we talk about merger, so two companies of similar size agree to combine, that's merger, and form a new entity. An example is ExxonMobil, where Exxon and Mobil actually merged together. The objective of merger and acquisition is to expand market share and geographic reach, to achieve cost synergies, acquire new technologies or products, or strengthen competitive advantages also, so that they could achieve faster growth and organic expansion. When we talk about merger and acquisition, the strategy process of combining two or more companies into one. So these are the following steps. These are the steps which a professional workflow looks like in investment banking and corporate strategy. So we start with strategy and planning. So we define strategic goals like market expansion, diversification, and technology acquisition. What actually do we want to do? We define strategic goals first, and either we want to we want to expand our market, either we want to diversify, or either merger and acquisition or acquiring a merging or acquiring with an entity will give us technological acquisitions. Then in this same process, in the same step, we identify target sectors or regions that align with buyers long-term vision in the first step only, and we determine the budget and the financing capacity along with the desired deal structure, whether we are going to pay with cash or we are going to pay with stocks or we are going to make it hybrid, some cash, some stocks. So determining budget and financing capacity, see, it's not that we only have to pay cash. An acquirer has to pay cash to the target company. So the acquirer can also pay in terms of stock options or stocks also. The second step is target identification and screening. So, conducting industry and peer analysis to identify potential targets, targets based on size, profitability, market position, and culture fit, and narrow down to a short list of possible companies. This is what we do in step number two. We the name itself defines the meaning, target identification and screening. So we are doing a screening of all the other companies, potential targets. We are identifying them using the process of screening. So we are narrowing our research on the basis of size, profitability, market position, and culture fit. and we are doing a target identification of peers. The third point is initial contact and confidentiality. So when we start with the process of merger and acquisition, buyer or their advisors contact the target company discreetly. In the when we when the process of merger and acquisition is about to start, if the target shows interest, both parties sign a non-disclosure agreement, and this allows the buyer to receive limited confidential information for preliminary analysis. So if the target company is willing to sell itself, so the buyer will actually have to sign, or both the companies will actually have to sign a non-disclosure agreement, because all this data is very confidential. If I were to acquire a company and if I receive their financial documents and I were to share those documents with the competitors, so that would be a loss for the company, a downside. So no non-disclosure agreements are signed in this step where the initial contract and confidentiality is maintained. So this allows the buyer to receive limited confidential data for preliminary analysis so that they can do an analysis. And after the analysis, the step number four where the preliminary valuation and indicative offers are done. So after the preliminary data, so they conduct an initial valuation using the methods like comparable company analysis, precedent transactions, and discounted cash flows. And based on the valuation, the buyer issue a non-bidding offer, NBO, or a letter of intent. So once the letter of intent is signed, this means they are actually going forward with the merger and acquisition. So letter of intent is very important in this scenario. So preliminary valuation indicative offer. So they are giving them an offer, and once they have just given the offer, they sign a letter of intent whether or not you agree with the offer, or is there any counter offer you would want to create. Afterwards, the letter of intent, unless until a letter of intent is not signed, the deal actually goes off. If the letter of intent is signed, this means the deal is going forward, it's moving forward. Then the part due diligence comes into the picture. So buyer conducts a detailed investigation into targets, the financials, legal matters, tax liabilities, HR and culture fit, operational and IT systems. And this aims to confirm assumptions and uncover risk in due diligence. Due diligence, they are trying to uncover all the risk. It's like looking into the closets, finding the skeletons in the closet. So that's the part, due diligence. After due diligence, there's a definitive valuation and deal structuring. This means that they update the valuation based on due diligence finding, decide how to structure the transaction. Either it's going to be asset purchase or stock purchase. Either they are going to buy assets, not liabilities, or they are going to buy company shares. Then they determine payment method, whether it should be cash, equity, debt, or mix. Hybrid, also known as hybrid. The mix is also known as hybrid. And they plan financing sources like internal cash, bank loans, bonds, or equity issuance. So this is where they start thinking about the money. Afterwards, they sign and negotiate. They start with the negotiation and signing. So negotiation is the final price, represents and warranties, indemnities, and closing conditions. Here, in the negotiating and signing, legal terms draft the definitive agreement. Board approvals are obtained from both sides. And here, b- board approvals are obtained from both sides. Once it's done, the financial regulatory approvals comes into picture. So now they are going to arrange funds and obtain regulatory and antitrust clearances. Example, competition authorities here in India, Securities and Exchange Board of India, or Securities and Exchange Commission in United States. So they actually get a approval from financial regulatory approvals and financial regulatory approvals from the government entities. And after that, there is once the transaction is complete, there is this closing phase, the step number 9, which represents closing, where they transfer the ownership and the payment is made, whether it's shares or assets. And the legal documentation is finalized, and the public announcement is made as applicable. This is where the transaction is complete. That's the closing. And the post-merger integration, usually known as PMI. So they actually combine operations, systems, and team, execute synergy plans, cost savings, product cross-selling, etc., and align company culture, HR policies, and IT system, and monitor integrating integration success with via KPI. So this is the post-merger integration. This is the step where if you are following the market, you might have heard that when a company acquires some other company, they actually lay off the management. This is the part where the post-merger integration, where everything now they have taken over the company and now they are implementing their own systems in the company. So the major key concepts, I hope this is clear. Step by step, we have discussed all the points, and I think this is important. And the other concepts which we are going to discuss very frequently during the merger and acquisition greetings are synergy. Synergy are actually the combined company is more valuable than the sum of its parts. Synergy means there is a competitive advantage, whether like we discussed about that in planning phase. Synergy means something if these two companies or two entities combine, or if it's acquired by the target company is acquired by the acquirer, so this is going to give them more value than the sum of its parts. Accretion and dilution, this is important. So accretion and dilution, if after post merger or post acquisition, if the acquirer companies EPS increases, it's called accretive, and if EPS decreases, it's called dilutive. This means there was a benefit of merger and acquisition, and this means that there was a loss after the merger and acquisition. Accretive and dilutive. Goodwill. The third term is goodwill, the excess of purchase price over fair value of net assets acquired. This is what the goodwill represents. Due diligence, we have discussed it here. So, comprehensive investigation before finalizing a deal. And the valuation multiples that we are going to use are the ratios like EV, bid, price to earnings, used to benchmark targets value. I hope you now have somewhat knowledge about mergers and acquisition. We have discussed the steps of merger and acquisition. We have discussed these key concepts. Now I want to show you how does a merger and acquisition model looks like. These are the snippets from my merger and acquisition model. So I just wanted to show you the snippets first. We will discuss about this model in detail later on. So this is the model where this model actually have four tabs. So deal assumption and analysis. We are assuming these are the assumptions. Then on the basis of these assumptions, I am going to make a performa model. Performa model means how does the model will look like after post merger and acquisition. This will be the acquirer company's data, and this will be the target company's model based on their historical numbers or the market numbers. What should be the target acquirer company's valuation, and what should be the target company's valuation, and on the basis of these, I will make deal assumptions and analysis, and on the basis of these analysis, I will create a performa data where both the entities will be considered as one. So look at this data. Here there are okay, let me just show you first the acquired companies data. So acquire companies data on the basis of acquire companies data, we have these scenarios: revenue growth, cost of goods sold, salaries, all the data from the acquired company. We have this data. On the basis of that data, similarly, we will also capture the data of target company, target model. And on the basis of target model, we will, this is the later on step, performa, three slides from that. On the basis of the target and acquire company, we will make deal assumptions and analysis. So on the basis of these, we are going to make transaction input, acquirer, target, acquirer share price is this much, target share price is this much, transaction close date is this. We are reporting these numbers in thousands, currency is USD. Restructuring charges, this much. How much restructuring charges we are going to give to our those institutions which are doing restructuring for us. Equity issuance fee is this much, 3%. Debt issuance fee is 3%. Other closing costs are 2000. So equity and debt issuance cost, this will also help us calculating the rate. Acquirers, FD share outstanding. These are the acquirer shares outstanding. These are the target shares standing. Shares issued. These are the shares issued. And on the basis of that, we are going to calculate performa share outstanding. So there are these are the outstanding shares, and on the basis of the outstanding share, this much shares are issued, and this will give us the performa in future. This will be the number of shares 73 to 83. Share issuance discount would be 1%, and share issuance price will be 11.63%, $11.63. So if we use synergy, so there are different scenarios. So in synergy, if say there is synergy in the model, so these will be the numbers which will look like. This is what the numbers will look like. If we talk about the financing, these are the actual numbers and these are the forecasted numbers. Here also, we are talking about the purchase price. So target share price is this much. Takeover premium is 25% and offer price is 21.63. Acquirer's share price is 11.78. Share exchange ratio is 1.840. So we are going to not only give the cash, or we are going to issue stocks also. 1.840 times of the ratio. Target shares outstanding are this much. Offer price is this much. So purchase price will be 546.25. Target, we are using debt here. Cash here and enterprise value will be this much, 487,776. This is what uh, merger and acquisition models look like. Here we have also conducted a sensitivity analysis of revenue versus takeover premium and share price impact also. This is the offer share price. This is the market share price as per DCF. This much is we are getting. Acquirer share price is this much. As per the DCF, it should be this much. Performa price per share is this much. Change in acquirer's net present value per share is one fall by 1%. Accretion or dilution. If we were to give takeover premium, if we, more we increase the takeover premium, the target share price will be decreased. This is going to be a loss for us. So if we are giving, the ideal case scenario will be 18 to 20%. Target share price should be 18 and the takeover premium should be 20. That will be the best case scenario. We can go for 25% premium. That will be a good positive for us. If we go for 19% premium, 19% share, $19 share price and with a 20% takeover premium, that would be 1.9%. Until here, until here 60, that's our green zone. But afterwards that, all these numbers are negative. And if we talk about performa numbers, so here in performa numbers, now understand this. Of the earnings per share, these are now combined numbers. And on the basis of this, Even though we have there was a dilution impact, the impact was initially diluted, but later on in the pre, future in the future, the process, the impact of merger and acquisition is actually accretive. It goes on accretively. So this is what I actually wanted to discuss with you guys. And we have now combined both the companies as one entity. And based on that, this is merger and integration model. So we have combined both the numbers here in this model. And on the by the ba- on from that, we have created this numbers. We have created this much. So acquirers net earning and the acquirers number of shares, performer number of shares. If we divide the performer numbers of performer net earning with the performer number of shares outstanding, we will get a performer EPS. And this will be lesser than the acquirer's EPS. So it will actually give us a negative. So this will give us a dilution impact. So earlier, this means, so understand this thing. Acquirer, we are talking from the perspective acquirer. Acquirer's previous share, acquirer's earning per share previously was 0.66. And if after merger and acquisition, acquirer's EPS has fallen down to 0.54, this means this is showing a 19% decrease or a 19% dilution. Here, again, it's acquirer share price EPS earning per share is 0.75 and acquirer's performer earning EPS is 0.70. It is showing as -7. But here, now the acquirer's EPS is 0.81 and the performer EPS is 0.86. This is giving us a accretion in the earning per share. We cannot estimate what the market value or the market price of the stock is. We will only focus the earnings per share to understand this thing. I hope this actually had made sense and you are now, if you have never seen a merger and acquisition model, so now you are familiar with how does a merger and acquisition model looks like. So we have taken into consideration everything: debt, income statement, balance sheet, cash flow. We have also done a performa DCF valuation, and on the basis of that, after both the entities are merged, we have calculated the stock price. So this should be the stock price, and if above this the stock price goes, our merger and acquisition will be successful. So this is how a merger and acquisition model looks like. I hope this actually had made sense to you guys. And don't worry about anything. We will discuss about merger and acquisition, discounted cash flow, and other valuation methodologies in detail when we will discuss about when we will complete this series. So now let's get back to where we started from. So let's start with merger and acquisition question and answers, Q&As. So question number one is walk me through a basic merger model. So they are only specifically asking about merger models. And a merger model, we have just discussed about it. A merger model is used to analyze the financial profiles of two companies, the purchase price and how the purchase is made, and it determines whether the buyer's EPS increase or decrease. So step one is making assumptions about the acquisition, the price and whether it is cash, stock, or debt, or some combination of those. Next, you determine the valuations and the share outstanding of the buyer and the seller and project out the income statement for each one. Finally, you combine the income statements, adding up the line items such as revenue and operating expenses and adjusting for foregone interest and cash and interest paid on debt in the combined pre-tax income line. And then you apply the buyer's tax rate to get the combined net income and then divide by the number of shares total, the new share counts, pro forma share counts to determine whether it was an accretion or a dilution. And finally, you can layer in sensitivity analysis to test different deal structures for synergy assumptions. We have just discussed about these. So this is when somebody asks you, walk me through a basic merger model. So this is what you will reply to them. All right. I hope this was clear. And if you think about it, model takes into account the purchase price of the target, financing method, and projected financials of both the buyer and targets. So this you actually have to think about. You actually have to forecast project financials of both target and acquirer, and on the basis of synergies or cost saving that might result from combining these two companies, you will actually make assumptions, and on the basis of assumptions, you will make a performa model where both the companies are actually uh, both the companies are acting as one entity. So basically, it's the to setting up the assumptions is the first step. You then analyze the buyer and seller's financials, combine the financial statement, calculate the EPS, and then you option analyze. You test different financing structures, sensitivity analysis. Do you test different structures, sensitivity analysis, and impact on key ratios. And this is how. So, if, in summary, a merger model is essentially a what if tool that what if the two companies are combined. All right, I hope this made sense. Now let's walk to question number two. So, what is the difference between a merger and acquisition? So, merger and acquisition, by definition, merger is occurs when two companies of roughly equal size combine to form a single new entity. Legally and operationally, both companies may cease to exist independently and new company may be created. The goal is often to create synergies, share resources, and increase market share. Acquisition means that an acquisition happens when one company, usually larger company, the acquirer and the target, purchases another company. The acquirer company may continue to operate under its own name or may be absorbed entirely. The buyer clearly assumes control in acquisition. Size and control, if you talk about size and control, in merger, typically companies of similar size actually merge of similar market value. And in acquisition, the buyer is usually much larger and it takes control over the target company. If you talk about the structures, a merger can be structured as a statutory merger, where one company survives legally or a consolidated, completely new company is formed. Acquisition can be friendly, both parties agree, or hostile, where target resists, but even after target resists, they actually acquire the company. Acquisition can also involve purchasing stocks and assets. So strategic purpose of merger is actually mutual benefits like cost saving, which is synergies, combining technologies, expanding customer base, and competing more effectively. An acquisition usually aims to at strategic growth, market expansion, eliminating competition, or acquiring technology, intellectual property, or talent. So this is what acquisition looks like. If you think about the perception, so merger is often framed as a merger of equals, representing both companies are as collaborative partners, and acquisition seen as one company taking over another, where the buyer is the dominant. Uh, Recent examples, there are no recent examples, but in 1999, Exxon and Mobil were the two companies which merged. And in recent times, if you talk about acquisition, so Facebook actually acquired Instagram, and also Facebook acquired WhatsApp for the enable in for the for to expand its capabilities and market reach. So these are two examples also. So let's go to question number three now. So why would a company want to acquire another company? So companies actually pursue acquisition for a variety of strategic, financial, and operational reasons. Each reason can depend on the buyer's objective, market condition, and the characteristics of target company. Uh, if you think about it, to increase market share could be one reason. Accelerate growth could be another reason. Buy undervalue assets could be third. I mean, one more reason. Acquiring customer and revenue stream, obtaining critical technology, achieving synergies, strategic positioning. These could all be the reasons why someone will acquire a company. If it so, increasing market share means that one of the most common. These are actually one of the most common reasons for the acquisition to expand market presence quickly. And by acquiring a competitor, the buyer can consolidate the market and reduce competition and gain access to the competitor's customers, distribution channels, and geographic presence also. So example, if you think about an example, so company operating regionally might acquire a competitor in a new region to instantly expand its footprint without starting from scratch. Uh, and if we think from the perspective of growth, so organic growth can be slow or resource intensive. An acquisition allows a company to scale faster than it could internally, and this is particularly useful in industries where speed matters, such as tech or pharmaceutical, where time to market is critical. Uh, Buying undervalued asset is one more possibility that actually favors acquiring. So sometimes a buyer identifies a company whose market valuation is lower than its intrinsic value. If the target is undervalued, the acquisition can be smart. Acquisition can be a smart investment that increases shareholders' value once the market recognizes the company's true worth. And acquire, or if we think about from the perspective of to acquire customers and revenue streams, yes, companies may acquire others to gain access to their customer base. This can create opportunities for cross selling or upselling products and services to new customers, increasing revenue more quickly than acquiring customers organically. So these are the few points where acquiring another company makes sense, and along with the strategic positioning beyond immediate financial gains, acquisition can help a company to strengthen its strategic positioning also, such as entering a high growth market, diversifying its offerings, or preemptively acquiring a competitor to prevent rivals from gaining an advantage. In short, in acquisitions are actually a tool companies use to grow faster, gain competitive advantage, capture value, and enhance long-term shareholders' return. Each deal may emphasize different motivations, but most involve a combination of market share growth, customer acquisition, technology access, and synergies. So this was pretty much it about acquisition, and we have discussed about acquisition previously also in other readings, and today also in the beginning of the session. We will discuss about, so these financial concepts, these never go off. Somewhere around these are linked with other financial concepts, so we will keep on discussing about these concepts. That's why uh, let's not worry about whether or not there will be a I mean, with better questions you will get a better understanding of these examples also. So this is how actually, when you are being asked a question about what why would a company acquire another company, this is how what you actually do answer. This is how you actually should answer. And all right, move to question number 4. Why would an acquisition be dilutive? And we have discussed about the dilutive. An acquisition will, if it reduces the acquirer's EPS, it will be dilutive. So an acquisition is actually considered dilutive when it reduces the buyer's earning per share after the deal is completed. EPS dilution occur when the additional net income generated by the acquirer's company is less than the incremental costs associated with financing and executing the acquisition. These costs can include several factors like foregone interest on cash. If the buyer uses cash to fund the acquisition, that cash is no longer earning interest. So the loss of this interest income reduces the net income contribution from the deal. Additional interest on debt or share issuance effects. And along with those, accounting impacts are also there, which could create a share EPS dilution. So amortization of intangible assets, transaction-related cost, stock-based compensation, these could be a cost. So certain non-cash accounting items can further reduce reporting earnings, making an acquisition dilutive. So the most common examples we have just talked about: amortization of intangibles, transaction-related cost, and stock-based compensation. And in short, if you think about it, an acquisition is diluted when the financials and accounting cost of the deal outweighs the net income contributions of the target company. And it's important to note that dilution does not necessarily mean the acquisition is bad. It could still create long-term strategic or cash flow value, even if EPS decreases in the near terms. If you remember, I just had showed you this thing. So in the near term, the EPS is decreasing, but in the future, the EPS is actually increasing, and this is giving us an uh, strategic long-term value. This merger and acquisition is actually giving us a strategic long-term value. All right, let's move to question number 5 now. So, is there a rule of thumb for calculating whether an acquisition will be accretive or dilutive? And yes, we have discussed about it. And yes, there is a rule, and absolutely, you have to be very careful before you actually have to be very careful through with the model before you answer these kind of questions. So, accretive deals means that the acquirer's earning per share is increasing after acquisition. And dilution means the EPS is decreasing. All cash or cash and debt deals. Dilution is impacted because of the cost. So to reduce dilution, if we use all cash or cash and debt deals to fund over to pay off our merger or acquisition, so this will create a accretion. So think in if we talk about all cash or cash and debt deals, which are hybrid. So interest expense, if debt is used, we actually have to look into interest expense. If debt is used, acquirer will pay interest on the debt. This reduces net income. And opportunity cost of cash is used. If cash is used, you lose interest income and you have earned by investing other cash elsewhere. So you will, if you are using debt, then you actually have to pay interest. So you will be reducing net income. And if you are using cash, then you will be losing your interest income, which you might have earned by investing somewhere else. S- So in simple terms, compare the combined cost of financing first. If the target's earning are greater than the financing cost, the acquisition is likely to be accretive. And if the financing cost exceeds the target's earning, it's dilutive. If we talk about, we are only giving them all the stocks rather than cash and debt. If we are giving them stocks, so this means acquirers issue shares to fund the deal. And the impact depends on relative valuation. So, price to earnings ratio, if the acquirer's price to earning ratio is greater than the target's price to earning ratio, EPS is going to be up, means the deal is accretive. And if the acquirer's price to earning ratio would be less than the target's price to earnings ratio, EPS is going to be down. So, that would be an dilutive. That would result in a dilution. So all stocks, if we talk about all cash or cash and debt. So all cash means if you are paying all cash, so you will be losing the interest component. If you are paying cash and debt deals, so if you are including debt, then you will actually have to pay interest. So You actually have to be careful when using these in all stocks. You actually after pay so that will impact the price to earnings ratio. If the price to earning ratio of the acquirer is greater than the price to earning ratio of the target, it will be accretive. If it's less, it will be dilutive. And third is the mix of deals where the cash, stock, and debt are used. So you account for interest expense, foregone cash interest, EPS, dilution from stock issuance and synergies, or integration cost at all at once. And there is no simple rule of thumb because each component interacts with other. So if you are using mix of these, you actually need to uh, you will require to make a pro forma model where you will forecast combined net income, calculate weighted average shares outstanding, compute post deal EPS. The key is to understand that these are not the rules of thumb, works best for initial intuition, but the final assessment always comes from a proper pro forma analysis. I hope this was clear. So let's do one thing. Let's conclude today's session here only. In the next session, we will be starting from question number five, six onwards. Uh, I hope that today's session was interactive and you understand what the merger and acquisition actually is all about. So all the very best learning. And if you have any doubts, kindly post comments in the comment section, and I will be happy to answer those. Thank you, and all the very best learning.